Drama on Wall Street and in Washington again today. It capped off a rocky and ugly week for stocks. After that 700-point decline yesterday, the Dow fell sharply again today, pulling the index down more than 10% from its most recent highs, and the S&P 500 just shy of that key 10% correction level. Concerns about a trade war and the threat of a spending bill veto kept investors on edge all day today, although in the end, the president did sign the bill into law. We'll have more on that in just a moment. But first, the closing numbers. Here they are. The Dow down 424 points today to 23,533. The Nasdaq tumbled by 174 and the S&P lost 55. The crazy day capped off a crazy week. The major averages all down more than 5%, registering their biggest percentage weekly declines in more than 2 years. Pisani has more now on the nervous market from the New York Stock Exchange.
Stocks were mostly sideways today until the last hour and a half of the trading day when stocks drifted lower on a large volume of orders to sell stocks at the close. The big problem is that the two most important sectors, banks and tech, are not showing any leadership. Without them, it's hard for the markets to advance. The Dow moved in a 1,400-point range this week. The market showed it cares about a lot of things. It's worried the Fed might be getting more aggressive on interest rates. It was even briefly worried that the president might not sign the spending bill, but he did. It's worried about technology a lot. That's been a key leadership group all year. But Facebook collapsed in the wake of its data mining scandal, and other social media stocks took a dive. Subsectors that powered tech higher last year, like FANG stocks, including Amazon, Netflix, and Alphabet, have sold off. Energy and utilities have led the charge this week, but they comprise a much smaller chunk of the S&P 500 that banks and tech stocks do. But the single biggest worry is trade protectionism. That's because it is potentially a threat to earnings growth, which is the main driver of the stock market. Earnings are expected to increase about 20% this year. That's a lot. So even a modest threat is enough to cause a lot of volatility. Tariffs have the potential to cut earnings growth forecasts, particularly in global industrial stocks, but it's difficult to model into these earnings forecasts because we don't know where these tariffs are going to settle out or what industries they may ultimately affect. You see, you get a lot of chaos as a result. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.